Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, we are going to talk about mortgage rates
Woohoo!
and how this is going to affect the housing market. Because even though we just did a mortgage rate update about a week ago, rates are tanking at a faster rate. They're
Right.
dropping at a faster rate. So maybe this is who knows what this is. Here's the article, and then let's talk about, there's a bunch of data and a bunch of charts.
Yep.
This is going to tie everything up into a neat little bow, I think, for people. Okay. U.S. housing market shows signs of life after mortgage rates fall. Juana, this is kind of misleading. Signs of life. Okay, let's start with new home construction. If you go to a new home site, are there just homes sitting around that nobody's purchased?
No, and as a matter of fact, I got an update from a few builders that I've been working with in the last few weeks. And the update was that they had two, but now they only have one, or they have none.
Are there a bunch of resale homes sitting around that nobody will buy because nobody can afford a mortgage?
There are a bunch of resale homes. They are sitting around, but that's not the reason why they haven't been sold.
Why haven't they been sold?
There's a variety of reasons. Maybe they're priced incorrectly. Maybe they're not in a neighborhood that's particularly desirable. All kinds of reasons, but it's the reasons why homes don't sell in any market. And then the other reason is, of course, that homes do take a little while to sell. So right now we're still selling homes in about a month or so. So if you just
that long?
So if you just came on the market and yesterday and you haven't sold by today, well, that's okay. It takes a little while. So particularly with Christmas right now and New Year's coming up, people have other priorities. People have a house full of guests, which will give them impetus to go shop for something bigger come the beginning of the year. But right now they're busy trying to take turns going to the bathroom with a house full of people and cooking and doing all those fun things.
The number of homes on the market, let's just use Vegas because we know the numbers, compared to last year, less or more?
Less.
Okay, so there's less inventory for people to pick from.
Yes.
Okay, what about pre-pandemic?
A lot less.
A lot less, okay. Right, so it's not really that interest rates have stopped people from buying. There's just not enough homes for people to buy.
Interest rates have not stopped anybody from buying. We'll just stop there. It means certain people have had to adjust their sites, and certain people, granted, are priced out because of interest rates. But that isn't the reason why homes haven't sold. Homes are selling.
Okay, here's a quote from the article. This is from Bloomberg. Even before the Federal Reserve has begun cutting interest rates, the mere anticipation of such moves is already thawing the U.S. housing market. There's used that word again. I don't think it's not like that. If there were 4 million homes sitting on the market, like there were in 2006, okay, this would be different. All the people are buying to buy up all the houses. People aren't buying because there's nothing to buy.
Right, there's nothing to buy. So this kind of reminds me of like when you smell, brownies or cookies or something like that, and you start salivating. It's like that.
I remember going in the MLS and looking in an area where it's like two big neighborhoods right next to each other that are all like average tract homes, but they're pretty nice.
Okay.
And we already have a rental in there. And I remember looking in there because I wanted to see, like, could we buy another rental or what prices were? Like, how's our rental doing that we bought 2 years ago? There was zero homes on it. Like, I grabbed the area and nothing came up as available, like for sale. And I was like, what? This can't be right. And I thought maybe I had the criteria wrong. And once I added like solds and other stuff, there had been a couple solds. There was literally zero homes available for purchase. Okay, here is a quote from the article. A series of reports this week showed activity coming back to life. Housing starts surged to a 6-month high. Sales of previously owned homes picked up from a 13-year low. And builder optimism was boosted by increased interest from prospective buyers. Meanwhile, Americans' home buying plans rose this month by the most in more than a year. This is like super optimistic.
It is, but the home buying plans have gone up for everybody because people have put this on hold. So it's kind of an artificial number in the sense that it's encompassing people that should have bought over the last year and a half and didn't. And so they're kind of being tacked on to people that would have bought now anyway. So that's why the number is higher maybe than expected, and it's going to do nothing but grow as more people kind of get into that situation. And I was kind of making fun a few seconds ago about the people having to wait their turn at the bathroom at home, but there is truth in that. I mean, people have outgrown their homes over this time. Their needs have changed, and they do need to find a different housing situation. So I think a lot of people are going to look in the spring, particularly with interest rates having gone down. They've gone down enough that people are ready to jump back in the market.
There are definitely green shoots on the housing front, said Charlie Doherty, senior economist at Wells Fargo. You're already starting to see the effects of lower expected interest rates, boosting a lot of different facets of the housing market. Do you think, I mean, this is so optimistic. It sounds like, I mean, I wasn't hearing this at the fall. This is December. Mm-hmm. I wasn't hearing this. And these numbers are based on, like, the end of fall is usually still pretty slow. We're in the winter now, and I am feeling more optimistic that the spring is going to be could be like 2021.
Right. So, we've had a lot of closings here in December, which is pretty typical, as a lot of people try to get their homes purchased before the end of the year to take advantage of whatever tax breaks there are associated with that. But we're also having, more people looking for homes, right? And we know that people looking for homes over the holidays tend to be more serious because obviously we all have other things to do with our time over the holidays besides look for a home. So we know these are serious buyers. We know that the number of buyers is going to do nothing but increase as we go into January, February, March, April, partly because of springtime, partly because interest rates are down, partly because we're anticipating more inventory, so more homes from which to choose.
The decline in mortgage rates should start spurring some home buyers to list their homes in the coming months, according to Lauren Chun, chief economist for NAR. As supply remains an issue, mortgage rates approached 8% in October, the highest in over 2 decades, but nearly 2/3 of homeowners have a mortgage rate below 4%, making it unappealing to sell their current homes. This is actually inaccurate. It's not 2/3 of owners. It's 2/3 of what?
Of borrowers.
Well, it's 2/3 of people who have a mortgage.
That's right, of borrowers.
42% of people own their home free and clear cash.
Right. So, but this is what I want to kind of point out. So if you've got one of those 3.5% mortgages, and now you're looking at maybe getting a 5.5% mortgage, it's not that big of a stretch compared to when it was at 8%. Okay. So you can kind of reconcile that in your head and you go, hey, you know what? Yes, it's 2 points more than what I've got, but I can live with that. And when rates improve further, I can refinance. But the stretch between 3.5% and 7.5% or 8% was a little much for most people to overcome. But 3.5% to 5.5%, now we're getting in the ballpark.
Okay, this is what Juan is alluding to. For the last 20 years, if you sold a house, your interest rate was up here, and the next house you bought was down here because interest rates fell for 20 years. Even though they fell slowly, they fell. So you would always sell this house, extinguish the loan, and roll the money to the new house, then get a home at a lower rate. You kept doing that. Well, with interest rates so low, you're not as inclined to sell this house to grab the equity to the next house. You're more inclined to keep it. So what a lot of people are doing is these people that with the low rates are still buying their next house. Right? They're moving and buying the house. They're keeping this as a rental because the interest rate is so low and their payment so low. It's like, why would I give that up? I don't really need the equity, or I can just get a higher, I can just borrow more money over here. And, to a lot of these people with the low rates, you can literally get a more expensive home with a higher rate, rent it out, and then use the difference in cash flow to make up for the excess payment you would have made by extinguishing the loan.
Right. So what he's saying is that your house at 3.5%, the difference between your mortgage payment and what you're receiving in rent, you can use that difference to pay on your new mortgage. So making your mortgage feel like a 3.5% interest rate mortgage because you're using this money to do that. So I think a lot of people are going to do that, and a lot of people, I think, are going, depending on what their price points are, may even find that it actually feels like even a lower interest rate than that 3.5%, depending on their price point.
Here's another quote. He saw the impact from the decline in mortgage rates firsthand. The average rate for 30-year fixed slid for the fifth straight week to 6.83 the week ending December 15th. This is over a week ago. The lowest since June, and it's expected to fall further as the Fed cuts their overnight lending rate. Now remember, that's not going to happen until March or April. but the rates have fallen since this article because I've got more data and a chart's going to be really cool. The minute that rate came down to the sixes, we had numerous people, Reeves said, the buyer market had filled back up. So as soon as the rates got under 7, buyers flooded in. Okay. All right. Here's another quote. Sales are up 20% this year for Willie Nunn, who's president of home building company Homes by West Bay near Tampa, helped in part by fewer supply chain problems than last year. While it's still below what he calls the pandemic mania, when rates plunge, he still characterized the current pace as strong. We're building up to a huge spring, Nunn said. Website traffic looks really positive, indicating pent-up demand. Now, why this? You're probably saying, but Todd, this is a private builder in Tampa, yada, yada, yada. But if people there are in a position where they're ready to buy and demand is strong, you can assume that there's probably other people in other parts of the country who have having the same feelings. For pent up, right, Juana?
Yeah.
There's pent up demand. Interest rates are more appealing. Economy's going good. We have wage growth. We have low unemployment. These are like all the signs for strong buyers.
Right.
Buyer pool, right? Okay. This is a chart of interest rates since beginning of the year, basically the last 12 months. You can see the run up and you can see the fall off. It's actually fallen since this chart. I've got another chart to show you. Rates are down again from this chart. That's how fast it changes. Like 3 days, rates have fallen substantially. But you see the peak there, it got almost 8%. It's already down to 6.83%. I think that's the steepest decline in lending I've seen in a long time in mortgage rates, right? Don't you think about that?
Yeah. And look, this is good for everyone. It's good for buyers because it makes it easier for them to borrow. It's good for sellers because it makes it easier for them to also be buyers and to sell their homes. So it's good all the way around. It's good for lenders who have had a tough year. So it's nice for them to be able to do some refis and some new loans. So I'm happy for them. And it's good for real estate agents and everybody else involved in the real estate space because there will be more transactions in 2024 than in 2023.
It actually says on this chart the 2-month drop is the largest since early 2009. It's the largest drop in interest rates in 14 years. Boosting optimism about housing. That, Juana, doesn't that literally mean housing crash? Right?
Actually, it just means that the crash bros will have to find some other way to twist things and continue to get their eyeballs.
If you're a doomer, isn't this going to be a really terrible Christmas with like literally every piece of economic news that you have heard over the last 2 years that's going to crash housing is fully on the opposite side of the spectrum for what you would be saying that's going to crash housing?
You know, I think people who are of that mindset will simply disbelieve the data and continue down their path.
Okay, here's the next chart. Okay, this is the bottom chart is what we're looking at here. This is inventory. Okay, this is over the last 6 years. Now, those humps are the seasonality of inventory. And you can see here that little trend arrow pointing down. And you could see that inventory today is the lowest it's been in the last 6 years, probably even well before that. And the trend is that we're less and less inventory for home. This is homes available to sell. So, Juana, what does this mean when the number of homes available for purchase is dropping? The supply of homes are less because you have people locked into low rates that are saying, forget it, I'm not getting rid of my low rate, right? So you don't have the churn that we used to have before.
Right.
You have home builders under building for, you have home builders basically building 600,000 to 800,000 new homes a year, but we have 2 million household formations a year. And the household formations are people who leave like their parents' house and go start a family, right? Or they leave college or whatever, or people who immigrate from another country, they come here, right? Like you guys came here, you immigrated, and then you guys went and bought, you went and rented a place. That was a household formation, even though you weren't a homeowner. We know that we need to build at least 1 million homes if we have 2 million household formations. So this really exacerbates we're talking long term, potentially home prices.
Right, because long term, there's still more demand than there is supply. The supply doesn't look like it's going to catch up with the demand for many, many years, if ever.
Okay. So we did a video we read this article, we shot another video, and then we want to do this video because we want to get the data. And then literally today, this article pops up. Mortgage interest rates today, December 21st, 2023, low rates likely to push prices up in 2024. Now, remember all the rates we've been showing you on the thing? Okay, these are the rates today. These are mortgage rates today. This is of 12, so this is as of 12/22, 2023. So the last working day of the month, right? Which is Friday, okay? Which was yesterday. Okay, a 30-year mortgage is 6.25%. A 20-year fixed is 5.9%. A 15-year fixed is 5.54%. A 7/1 arm and a 5/1 arm, for some reason, are more. I don't know why they would be more, probably because they lag. A 30-year FHA is 5.68 and a 30-year VA is 5.54. I was just quoted, I think 2 days ago, 5.83. 5.83 for it was 6.35 for a 30-year, and now it's 6.25, so it's down 0.1% in 2 days. And then a 5.8% on a VA, which is now 5.5%.
Right, and then remember, all of this is also dependent on your credit, on how much you're putting down, and all these other things. So depending on those things, maybe your numbers are better. Maybe your numbers are not as good. But this just kind of gives you an idea of what's out there.
Yeah. These rates to me, literally, this is very optimistic. I believe the economy is slowed enough, the Fed will start backing off on they'll start reducing rates. And I think the money is going to start flowing again. I think the 10-year is going to absolutely tank. And I think that the mortgage rates are going to get super competitive again. If we go into an expansion phase, remember that spread between the 10-year and the 30-year fixed is mortgage, 10-year treasury, 30-year mortgage, is 2 to 3%. It's 3% when there's uncertainty, and it's 2% when there's more certainty. And we get in these nice, gentle expansions, it tends to be 2%. Now, remember, think about this. That rate gets down to 2%, and then we get 2%, because we have certainty. We now have 4% interest rates again. And I think 4% interest rates absolutely, if you haven't bought a house and you're waiting a year or two for the housing crash or whatever, I think it's too late, right?
Well, yeah. But we're not saying that we're expecting 4% interest rates in 2024. So
not
please,
in 2024.
Understand that. We are expecting interest rates they're already honestly lower than we had expected them to be at the end of 2023. Is it possible that they're going to hit 4% 2024? Sure. Do we think that? No. I think this is going to be kind of a slow thing, and I think it's going to also depend on how the economy continues to do. If the numbers from Christmas come back really robust, then the Fed may hold off longer on lowering interest rates, because the Fed will continue to be concerned about inflation. I really think that the Fed's concern about inflation is going to still dominate their decision-making for the first and second quarter. I don't think that the election is going to play that big of a role in the first quarter for them. I think as we get closer to the election, they might consider that more, but I think right now they're still really concerned about inflation.
Okay. Before you can refute the data. We got this data. This was actually correlated by CoreLogic. The data was gathered. Remember, I just told you what I was quoted. That 30-year fixed and that VA loan data was on a large purchase size. So I don't know if rates are lower for a smaller purchase. They might be. There might be a little premium to pay for a higher purchase price, right? So these rates, though, are pretty... If we'd have asked us to... Now, remember, if you watch our channel, we tend to be optimistic. We would never have guessed 8 weeks ago.
I think we tend to be realistic.
Okay. If you had asked us 8 weeks ago about these rates, and you'd shown us this and said, when do you think rates would be? I probably would have said end of 2024.
I would have
over 1%.
I would have said that I was expecting that probably end of first quarter or sometime in the second quarter of 2024, but certainly not, in 2023.
Now, the question, this is the last slide we're going to show you. We'll talk about real quick. So all of the legs of the housing crashers have been completely wiped out. Every possible scenario of why housing could crash has been really taken away. There's this one thing, though, that people keep stomping their foot on. Todd, the consumer debt. There's people can't make their credit card payments. They're going to let their house get foreclosed because their credit card payments are too high, whatever, okay? So here we go. This is the share of consumers that have debt in collection, okay? This chart is the last 20 years of shares of consumers with debt in collection. This is from the data from the New York Fed, okay? It's 4.7%. So you could argue 4.7% of the population cannot buy a house because they have debts in collection that no lender will loan to them, right? Probably with a collection, you probably can't get a loan.
Okay, so if it's of the population, then the population also includes homeowners, so it's lower than that, but okay.
Right, because there may be some homeowners who have debts, they already have a loan, and they're locked into their mortgage, so they're not going anywhere.
And they don't care.
And then some of these are going to be renters who probably would never buy anyway for whatever reason, right? So the literally idea that people won't be able to buy because they clearly aren't financially capable, this number is counterintuitive when you see the chart where the amount of consumer debt that people have just broke, I think, $1 trillion for the first time. It's over $1 trillion. But what that shows, I think, is that people are spending money because they have jobs. They're increasing they're getting wage increases, and they have confidence about their ability to repay debts in the future. Right. I don't think it's because they can't live and they're having to put everything on a credit card. This is the opposite. The opposite would be happening, and you could clearly see the trend of this. Remember, great financial crisis, it was up in the, great financial crisis the next 5-6 years after that. It was approaching 15%. It's like 1 in 8 people, right? And now we have 4.7. That's less than 1 in 20 people. That's pretty, okay. Juana, looking at the rates, the rate chart we just showed, how do you see them in March, April, May, the peak buying system?
Lower.
Okay. I'm going to put the chart back up so they can look at the numbers here again.
Okay.
If the numbers are lower than this, let's say what, quarter point?
Yeah.
Okay.
I mean, honestly, following the pattern, it's going to be substantially lower. I just really don't see an economic reason for them to be more than a quarter point lower, but I also didn't see an economic reason for them having gone this low. So if I'm extrapolating from this chart, then they could be as much as 3/4 of a point lower. If I'm thinking logically as far as what the economy will do and using reasonable consideration regarding debt, regarding inflation, regarding all these things, then it should be a quarter point. So somewhere in that range is probably where the truth lies. So it'll be interesting to see where it is. So please feel free to bookmark the video and fact check me, when the time comes.
Every single person who has put in the comments over the last 3 years, I just downloaded this video so that in a year I can come back and prove that you were wrong. Not once has ever a person come back and said, here's your video, see all the places you were wrong. Because we've been right way more. We haven't been right 100% time, but we've been right way, way more than we've been wrong. But look at this, the 30-year fixed could be 6%. That would be pretty low, okay, in say 4 months, 4 or 5 months. 30-year VA could be 5.25%. All the veterans out there would be buying houses like crazy. 30-year FHA, that's most people. FHA is the easiest loan to get, and that is, there's a purchasing limit. Like you can't buy $1 million house with FHA, and it has to be owner occupant. There's some rules there, but I mean, you could really get 5.3% or something, right. 5 3/8. That would be a pretty smoky deal. Fixed year also at about 5.25%. If these drop to 0.5%, but you could see where this is going and what this is going to drive home prices higher. I think I'm going to say right now that I'm more optimistic about. I think I said home prices go up 3 or 4% next year. I think I was wrong. I think they're going to go up more next year because I think inventory is still going to be choked off. I think people are going to flood into the market. And I think we're going to see this nice steady push of home prices. Remember, they were up 6.4% nationally, 6.4% November to November. And remember, guys, the 5th highest market month over month in the nation of the top 50 housing markets. Las Vegas, the 5th highest appreciation from October to November in the U.S. And I see a lot of positive things happening. I see zero signs of housing crash.
Right. So, yeah, I agree with you that if I were to revise my my estimate as far as home appreciation for 2024, I think it's going to be greater than 2023. And a lot of that's due to the lower interest rates, and low interest rates are going to spur more buyers to come into the market, which is one thing, but I don't see the inventory keeping up with that demand. So because of that, I think the appreciation will be greater than in 2023.
Perfect.
Okay, so what do you think? What's going on in your neck of the woods? Leave us your real estate related comments. We appreciate them. Please remember to subscribe and hit the notification bell. We appreciate you helping us grow the channel. And like the video, that means a lot to us. We need the positive reinforcement. We need the attaboy and attagirls. And we'll see you on the next video. Bye.
Bye.